Sarah, I know that many of your customers are affluent millennials who've got, a little bit of money in the bank, some assets to move around. How are you advising them at this time?
So, it's interesting because philosophically, we have always believed in long-term diversification. And so, we attract a client base that believes in that philosophy and sort of stays the course. So in general, our advice is stay the course. And I think in some ways we do our best in this sort of economy, in this sort of volatile market, because tech-smart technology is a huge part of the value proposition that we offer.
Betterment was actually founded during a downturn. What comparisons do you see between then and now?
Well, it's interesting, some would say better to be lucky than smart, right? So when Betterment launched, it was a downturn. And so we were able to put some quick wins on the board for our customers. And I think that really holds true now as well. I know your last segment was on crypto and we're entering the crypto market. And I think the similarity I would draw is sort of where we are in the crypto space right now relative to where we were in the overall market a decade ago when we were founded.
I know you're working on a crypto product for launch later this year. What's your take on the broader crypto volatility and, Bitcoin at new lows?
Our view is that crypto continues to be an asset class to play for the long term. And we think about the asset class as a whole rather than thinking about the individual stories. So is it, Bitcoin or the rest of the coins kind of coming up behind? So our view is long-term diversification works in traditional finance and similarly works in crypto. And then from an advisory standpoint, we believe this is not an all or nothing idea, but we're going to advise our clients to keep less than 5% of their portfolios in crypto as a diversification play.
We've reported that FTX's Sam Bankman-Fried is interested in buying Robinhood. What's your take on that? How does that change the game?
Well, it's interesting. I think particularly in 2021, self-directed trading got a lot of excitement. And I think some combination of crypto and options and single stocks, folks thought that they were sort of smarter and more informed and that they could play the market in a really, self-directed way. And I think that often ends badly. In that market, we were preaching eat your vegetables while they were preaching, here's a piece of cake. And I think now you come out on the other side and eat your vegetables feels, pretty good and pretty tried and true. So, I think they're doing a variant of what we are. They're just doing it in self-directed, investing, whereas we're doing it in a sort of buy and hold advisory capacity.
Is a recession inevitable in your view? And if so, when does it happen?
I don't like to prognosticate particularly on that. I mean, I think the monetary policy right now that the government is putting forth is important to cool inflation. And I think that's really the number one objective. And threading the needle is really the key. Whether or not that needle is going to be thread between employment and inflation and interest rates is really going to dictate what happens in the markets.
How do you thread that needle in portfolio? Invest for basically either scenario.
Right. Well, I think, again, trying not to overreact. I mean, we, for example, behaviorally don't nudge customers to make too many moves. And so when we think about the savings rate environment right now and that rate going up, one of the things we're going to do is we're going to put more cash and recommend more cash into people's portfolios. But again, these are going to be sort of modest changes at the margin because on average and over time, right, dollar cost averaging philosophically makes sense. Taking advantage of the tax tools that are available to capture some extra beta there. So we think there's a lot of good in diversification, while we're seeing this market volatility.